How to invest in 2023. The first rule of investment is don't lose money, and the second rule of investment is don't forget the first rule. Famous quote by Warren Buffett. In today's fast-paced and ever-changing economy, it's more important than ever to understand the basics of investing and how to make the most of your money. So this video is for you, whether you're a first-time investor or a seasoned pro. Risk tolerance is one of the most important things to consider when investing. It's important to understand that investing always comes with some level of risk. Still, there are ways to mitigate that risk by diversifying your portfolio and investing in a mix of assets. Diversification is the key when it comes to investing. By spreading your money across different assets, such as stocks, bonds, and real estate, you can reduce your overall risk and increase your chance of success in 2023. Another important tip is to invest in what you know. It's important to do your research and understand the companies and industries you're investing in. This will help you make more informed decisions and increase your chances of success. With the advancements in technology, it's now easier than ever to research and invest in companies from the comfort of your own home. Various tools and resources are available to help you make the most of your money, from online stock trading platforms to robo-advisors. Nobody buys a farm to make money next week or next month. They buy it to make money over the long term. They don't get a quote every day. That's a better way to look at stocks. Warren Buffett again. In 2023, we can expect to see a continued focus on sustainable and responsible investing. This means investing in companies that are making a positive impact on society and the environment. Not only is this a way to align your investments with your values, but it's also been shown to be a financially sound strategy. Investing can seem daunting, but anyone can succeed with the right knowledge and approach. By diversifying your portfolio, investing in what you know, and staying informed about the latest trends and opportunities, you can make the most of your money and secure a bright financial future. Many people think Warren Buffett is one of the best investors of all time and has always pushed for value investing. This means looking for companies that are undervalued by the market and have strong fundamentals, such as a strong track record of earnings and a strong management team. Remember, even if the stock is currently dropping or has had a negative year or two, strong value-based companies always recover in the long run. And often, the stock price in the long run will catch up to the fundamentals. Buffett has also talked about how important it is to invest for the long term and to be patient. He has said that trying to time the market or get in and out of investments based on short-term changes is a bad idea. And remember, time in the market supersedes timing the market. In terms of specific advice for investing in 2023, Buffett has said it's essential to focus on a company's fundamentals instead of getting caught up in short-term market noise. He has also talked about how important it is to stay out of debt and keep a big part of your portfolio in cash if an opportunity arises. Also, Buffett is known for investing in companies with a strong brand, a good management team, a wide economic moat, and a successful business model. This could be a good strategy for 2023 as well. Warren Buffett's advice for investing in 2023 is to focus on value investing, be patient, avoid debt, and keep a portion of your portfolio in cash so you can take advantage of opportunities that may come up. One of the best ways to get a good return on your money is to start investing when you're young. This is because of compound interest, which means that the interest you earn on your investment starts to earn interest on its own. With compounding, your account balance can proliferate like a snowball. And this is often referred to as the eighth wonder of the world. And also see my main video I did on compound interest, which is linked as the trailer for this channel. People also often wonder if they can get started with a small amount of money. In short, yes, no amount of money is too small. Investing with less money than ever before is possible thanks to low or no minimum investments, no commissions, and fractional shares. Index funds, exchange-traded funds, and mutual funds are all types of assets that can be made with small amounts of money. If you're worried about whether or not your contribution is enough, think about how much you can afford to give, given your goals and financial situation. Brent Weiss, a certified financial planner and founding member of Facet Wealth, says, "It doesn't matter if it's $5,000 a month or $50 a month, as long as you put something away every month." For example, if you invest $200 every month for 10 years and earn an average annual return of 6%, you will end up with $2,400. You'll have $33,300 at the end of 10 years. You've put in $24,200, those $200 in monthly payments and made $9,100 in interest on your investment. Pretty good. The stock market will have ups and downs, but if you start investing when you're young, you'll have decades to ride out the bad times and watch your money grow. Start right away, even if you have to start small. But it's never too late, even if you missed the boat when you were young. How much you should invest depends on how much money you have, what you want to invest in, and how soon you need to reach your goal. One common investment goal is retirement. You should save 10 to 15% of your income each year for retirement. Right now, that might sound impossible, but you could start small and work your way up to it. If you have a retirement account at work like a 401k and the company matches your contributions, it's easy to reach your first investing goal. Put in at least enough to get the entire match, and if they're not paying a match, strongly consider leaving. By the way, that's free money when they match. You don't want to miss out on it, especially since your employer match counts toward that goal. For other investing goals like buying a home, getting a life-changing surgery, traveling, or going to school, think about how long you have and how much you need. Then work backward to figure out how much you can save each week or month. You can save for retirement in an individual retirement account, like a traditional or Roth IRA, if you don't have access to an employer-sponsored retirement account like a 401k. If you're investing for something other than retirement, you don't want to use a retirement account. These accounts are meant for retirement and have rules about when and how you can get your money back. Instead, consider a taxable brokerage account from which you can withdraw money without paying extra taxes or fees. Brokerage accounts are also a good choice for people who have contributed as much as possible to their IRAs and still want to invest, as the contribution limits are often significantly lower for IRAs than employer-sponsored retirement accounts. And specifically, for a Roth IRA, it's $6,500 in 2023 versus the employer-sponsored 401k, which is up to $22,500. Also see the other video I did a couple weeks ago where I just discussed this. Your investment strategy will depend on what you want to save for, how much money you need, and how long you have to reach your goals. If your goal for saving is more than 20 years away, like retirement, you can put in almost all of your money in stocks. But picking individual stocks can be tricky and take a lot of time. For most people, the best way to invest in stocks is through low-cost mutual funds, index funds, or ETFs. If you're saving for something you'll need in less than 5 years, you're better off keeping your money in a safe place like an online savings account, a cash management account, or a low-interest or low-risk investment portfolio. If you can't decide or don't want to, you can use a robo-advisor. This service uses computer algorithms to build and manage your investment portfolio and to open an investment account, such as an IRA. Most robo-advisors' portfolios are made up of low-cost ETFs and index funds. Robos make it easy to start quickly because they have low costs and low or no minimums. They charge a small fee to manage your portfolio, usually around 0.25% of your account balance. After you decide to invest, you'll need to decide what to invest in. Every investment has some risk, and it's important to know how much each one has and whether or not it fits your goals. And if a robo-advisor sounds scary, you can always consider a robo-sounding online financial coach like me, who runs this channel. Most people who are just starting out choose to invest in stocks, and a stock, again, is part of a company that you own. Equities is another word for stocks. The price of a share of a stock can be anywhere from a few dollars to a few $1,000s, depending on the company. Bonds. A bond is a loan to a company or government agency that promises to pay you back in a certain number of years. Between now and then, you earn interest. Bonds are usually less risky than stocks because you know exactly when and how much you'll get back. But bonds have lower returns over the long term, so they shouldn't be a big part of a portfolio or of long-term investments. And long-term subscribers of this channel know I'm not a huge fan of bonds, but I actually did some bonds in 2022, given the changing economic footing. Mutual funds. A mutual fund is a bundle of different investments. Mutual funds let investors buy a diverse group of stocks and bonds all at once instead of picking out each one individually. Since mutual funds are made up of many different stocks, they are usually less risky than buying individual stocks. Professionals manage some mutual funds, but index funds follow the performance of a particular stock market index, like the S&P 500. Index funds can charge much lower fees than actively managed mutual funds because they don't have a manager. Most 401ks have a carefully chosen list of mutual or index funds you can invest in at no minimum. However, if you invest in these funds outside of a 401k, you may have to put down $1,000 or usually $2,000 or more. I highly recommend the 401ks mutual funds because they have a much lower expense ratio and you're not paying an exorbitant upfront front load charge like you do for retail mutual funds. And I strongly advise staying away from retail mutual funds. Stick to no to low cost funds, exchange traded funds. An ETF is a group of many separate investments like a mutual fund. ETFs are different because they trade like stocks all day and are bought for a share price. An ETF share price is usually lower than a mutual fund's minimum investment amount. This makes ETFs a good choice for new investors or those with small budgets. ETFs can also be index funds. For specific funds for a 401k, I always recommend a large cap fund, possibly a small cap fund, depending on the trailing 3-year market performance, an S&P fund, and your company's stock fund if your company is publicly traded. This was all for today's video. Please subscribe to this channel and press the bell icon to get the latest updates from this channel.